We're excited this morning to have Joe Blackbourn with us on our Kiss My Assets podcast. I'm Jamison Manwaring. I'm CEO of Neighborhood Ventures. I want to give a little introduction to Joe, but also have him tell us a bit about himself. But I've known Joe for quite a while. When I first got into the real estate community here, he was part of a ULI and a competition that I did. And so I've known about him for a while. He's also very active in the Arizona State University MRED program. So excited to have you come in today and join us on our podcast, and want to learn more through the course of the podcast about your life and your story, and then helping folks who are in the industry, who are investing, and understanding what you're seeing in the industry with the valuable time that you've had. We'll dig into that also. So maybe to start out, if you could tell us a little bit about what got you to this point. You have a company, Everest Holdings, and we'll talk more about what you invest in then, but you can tell us a bit about what got you to this point in your career.
Sure. Thanks for having me, first of all. It's great to spend time here. So I started Everest Holdings more than 20 years ago, and prior to that, I was in essence an acquisitions professional for a large family office for 10 years. So I really only had two jobs for the last 30 some odd years.
That's different than today. Most people are switching every year too, so it's a longevity.
And prior to that, I had been a broker. Really, I had been with Grubb Ellis, and the family office was a client of mine, and I had been doing consulting work for them, and they hired me to come in and run acquisitions.
That's interesting to hear, kind of the evolution. So when you were doing brokerage, first of all, tell us what you liked about that, and then why didn't you keep doing that long term?
It's a really good question, because I loved it.
Yeah.
Honestly, I felt it was like catnip to me. I am a really competitive person. I loved doing deals. I loved talking to people, meeting people, negotiating. In those days, it's interesting because it's a long time ago, but the brokers wrote the purchase and sale agreements.
Yeah.
We wrote the LOIs. We didn't even have computers either. I mean, it was all you would tape paragraphs together and give them to word processing. There was a whole group of people at Grubb Ellis that did all the typing.
The word processing department, wow.
Yeah, and then we did all our own analysis, really, but without computers in those days. It was all with HP 12Cs. I mean, it was all on your calculator.
You got to actually know what you're doing when you do it that way.
Well, it has to. You have to have reps, and then it gets intuitive, and I was really young, and I thought I knew a lot more than I did, like you're prone to do when you're really young. And then I got hired by this, and so the reason I didn't continue, a lot of my friends that were there at Grubb Ellis are still brokers, and they do really well.
Yeah.
I mean, some of my best friends in the business, Craig Coppola, these people are, they make great livings. They continue to learn and evolve, and we were kids in the cubes together.
Yeah.
That whole Cushman and Wakefield office, evolved from Grubb Ellis, in the old days. Brian Carney, still runs that office. He was a kid in the cubes when I was there. And so what happened was the RTC thing. So I had just kind of gotten into business as a broker, and I had a lot of deals going. You have to start doing something else, as a runner. I was hired as a runner, so I was basically an indentured servant, which means I did a lot of work for no money. And then I went on my own. You didn't have to go on a team in those days. These days, everyone is organized around teams, so it helps you, basically you get into a support role and then you grow. And then the RTC thing happened and the entire market froze up.
Let's talk a little bit about that. I know a bit, but I know that was a pivotal moment in commercial real estate, multifamily. Can you tell us a little bit about what the background of ROTC and what the impact of that was in the market?
RTC was the Resolution Trust Corporation. And so what happened was during the 80s, there was a really and then, the genesis of it was over leverage, just like a lot of crises. Look, GFC was really over leverage in the housing market. In the leading up to the RTC, the savings and loans had been deregulated in the late 70s or the early 80s, and they were allowed to get into spaces that they weren't previously allowed to be in. The savings and loans were initially conceived just to support the U.S. housing market, and then they became, in essence, unfettered. And then they were bought by large conglomerates, many of them real estate development affiliates, and they were used to finance really risky, large-scale development projects. And Phoenix was growing like mad, and so, there were half dozen, 6 or 8 savings and loans here that got really big, and they had a huge amount of real estate on their books, and a lot of it was land development, although they dabbled in everything. And so then in the mid 80s, the government basically changed the tax code, and that precipitated this quasi-disaster, because they had previously allowed in real estate ventures limited partners or passive investors to take active losses, and then they changed that rule, and so a lot of the speculative energy that was going into the business at that time just abruptly ended. And we had been overbuilding multifamily to a great extent, and then we had been overbuilding in the community development space because developers owned savings and loans and were in that business. So a lot of the infrastructure that was built, and by the way, some of that were like Estrella Mountain Ranch, we're still on, building through. And,
yep.
You think about Superstition Springs and the islands and all these projects around town that were funded by savings and loans, over-levered. In other words, developers were borrowing like 110% of cost because they were basically imputing the valuation after they improved the property in order to justify that collateral amount, right?
Yeah.
And so things started to break down. And when things started to break down, in that case, because these entities were federally regulated, the government just elected to step in and take over the institutions.
And that was when the RTC came along.
Yeah, so they started the RTC, which was in essence to manage the liquidation of all of these loans. And so some situations became title. The government foreclosed, and in most situations, though, they literally sold tapes of loans. So you would go to auction on a portfolio of loans, and then you'd figure out how to get to title or do whatever you were going to do. And so that was and it took, like any crisis in our business, it took way longer to work through than you would have thought. But for the first 2 years or so, when this started to happen, you couldn't do a deal, because the government was in the business at that time of taking over the lenders and getting control of what they had, hiring staff to run it, closing down these entities. The only financial institution that survived in this town was Valley National Bank, and really only because it was bailed out by Bank One out of Ohio. Everything else done.
I can't imagine being in the industry at that time having that as the backdrop where you can't get a deal done. The government's getting very involved.
Well, the crazy part is I started in the business, and it seemed like the business was a carnival.
Yeah.
It was like a circus, right?
Yeah.
Everybody's making money hand over fist. There are all these parties, and, people are like becoming legends. It's like the tech thing, that happened, pre-2000. And then all of a sudden, it came to an end. And some people went to jail. In fact, a fair number of people went to jail across the country, but some local developers, obviously Charlie Keating being the poster boy for that.
Right. And so when that happened for you, you saw it as an opportunity to get out of brokerage and go into the investment management space or the asset management?
I was just trying to survive.
Yeah.
Honestly, like a lot of people. And I was not experienced enough to get hired by the government. I went out and applied for jobs. I almost went to work, for Bruce Ward at Trammell Crow Residential. And then one of my clients pulled me out and just said, we want you to run liquidations for us at that time. And it turned into acquisitions.
Wow. So
Yep.
that period was a lot of learning hands-on.
Yep.
If you're involved in that hand-to-hand combat, liquidations, and then transitioning to acquisitions.
Mm-hmm.
So that role, then how did that turn into Everest, and why did you decide to launch your own company?
Well, I had gone to work for a family office for about 10 years, a group that I had been doing consulting work for called Pivotal Group. And they're very smart people. They're still, doing, business across venture capital and real estate investment and development. And I just was exposed to so much. We did, very large master plan community deals. We did office portfolios. We did hotel deals and resort deals, and I was on the front edge of finding them and underwriting them. And it just it was like business school on steroids every year. And then it just came time, for me. I got to be an age where I decided that if I didn't give it a shot, I never would. And so, I was in my late 30s and decided to, start my own deal.
What was the mission of Everest? What type of assets did you want to acquire, and then how did you go about building that business, investors, the whole thing?
It's you plan, right? I wrote a business plan. I spent a lot of time on it. Almost nothing came to fruition. I mean, the one thing that came to fruition from my business plan is how my company's organized internally, because I had a vision for that. I wanted it to be what I would have wanted, coming in. I wanted it to be kind of a talent attraction and retention concept, so that people would come in and become owners of the deals that we did. But the product types themselves, I mean, I thought I would not do hotels. The first deal I did was a hotel deal, right? And so what happens is you just figure it out, and I had to make an income, and because I wasn't wealthy, it means that I had to do consulting work for people, and then I had to find deals at the same time. And what happens is you get out and you talk to people, and I'm sure like you do, you approach things in a relentless, persistent way so that you stumble into things because you get lucky.
Yeah.
And my first deal, I had a coffee with a broker. I happened to be a hotel broker just to keep up,
Yeah.
And he's like, listen, I had a deal fall out of escrow yesterday. You have to go look at it.
How big was that first deal you did at Everest? How big of a hotel was it?
250 keys.
So that's a big
Yep,
property.
250 keys with 10,000 feet of indoor meeting space.
Wow.
And it was at the corner of Peoria and the I-17. It was Crown Plaza property.
Oh, yeah.
The rooms had just been renovated. It had been owned by a REIT, and it was on a disposition list. And so it had been in escrow for $11 million or $11.5 million bucks. I went and walked it. I did the underwriting, was actually making money.
Yep.
And I made an offer of $5.6 million, and they took it. And so
Wow.
that's sort of like the dog that catches the car, right? It's just like, now what are you going to do? And so it was. I mean, that's how a lot of people start in this business, right? You stumble onto a deal, it's going to work, and you really believe in it, and then you have to figure out the capital.
Yep.
And I had been working with the institutional people while I was at Pivotal Group, but none of them wanted to do something like this. And
Right.
it was not a good-looking property, really, even though the rooms had been done.
Were you going to get some debt on it too, or was it all going to be equity?
Yeah, and so I ended up doing, the total capitalization was $7.1 million,
Yep.
including $1.5 million of public area renovation, which was, when you think about that, it was really managed down.
Yeah.
I was there every day,
Yeah.
with the contractor, and we had 50% loan from a Chinese bank, and then I had to find the capital, and a couple of doctors' families did it with me. And actually, Greg Vogel was in that deal. He was a good friend of mine at
Yeah.
Land Advisors, and we ended up selling that hotel in 3 or 4 years for $24.5 million.
Oh, wow.
Yeah.
So,
And there's a lot between buying it and getting to that, right? So it's hotels are complicated. We had to renegotiate the franchise agreement. We brought a new management company in. We renovated the hotel with, and blocking and tackling. And I literally bought all of the art for the public spaces at Z Gallery and hung it myself. I went over there with the engineering crew and hung it all. And then, of course, you just grind on the operation, and you we started out when we bought it with a little under $400,000 in NOI, and we ramped it to like $2.2 million.
yeah. And you did all the operations yourself? So you hired the team, or did you use an outside management
So
company?
we used a company called Driftwood Hospitality out
Yeah.
of Florida,
Yeah.
and but we were, in the hotel business, you can negotiate certain levels of control in terms of personnel, especially at the executive team level, and then you're engaged in, it's a little different than other forms of real estate. It's an operating business.
Yeah.
So we had weekly operating meetings with the team.
Yeah, and I would imagine, I have not done a large hotel, just a small one, but in order to get that NOI, it depends a lot on the team, the operations, who's running things day to day.
Everything.
Yeah.
They were going to move the general manager, and I went to the general manager and I said, "You're going to have a piece of the profit."
Yeah.
So he insisted upon staying. You can't, because you just can't lose somebody
No.
who's who is going to go to the mat and make it successful.
Especially if you're on track, you got the momentum. So, what are some of the other deals Everest has done? That's a great first one.
Yes, so I had done, as I mentioned, a lot of things at Pivotal. So going into this would have been, now I started the company in 2002, and we were still in a really robust residential cycle at that time.
Yep.
And I had previously been in the land bank business, which is a builder finance business. So we started a business in builder finance, at that time, and we raised a small fund, about $25 million, and went out and did $90 million worth of stuff with that fund, with a number of builders, and that
was more. Was that debt or?
It's really equity, but
Okay.
they call it finance, but it's, you own the real estate.
Okay.
So you basically, the builder tees up the deal, you come in, and they give you back, in essence, a deposit in exchange for a rolling option to purchase the lots, either on a fixed price or a floating price basis, or a, in essence, it looks more like debt if you float over a benchmark rate. And then they also, you write a GMP with the builder, and they manage the horizontal improvements. So this is just A&D.
Yep.
And they buy the lots from you and build through it over time. And they use this mechanism to hold land off sheet because their return on equity looks a lot better as a company, and their share price is enhanced. These are mostly public builders.
Got it.
Although we did builder business with privates also. So then coming into the GFC around 2006, we saw the housing market weaknesses coming. We were early because, of course, we had deals with builders, and their sales volume started to drop really fast. And so we raised a fund that was more of a distressed land and infrastructure fund for $125 million, and to be ready for that.
Yep.
And then we, with an institutional partner, so that was our first institutional partner, and they took $100 million of the $125 million.
Wow.
A private equity manager.
Yeah.
But I had actually hired a placement agent and was doing a roadshow around the country to raise that money directly among mostly family offices and university endowments at the time.
Yeah, good timing, and I'm sure that worked out well because there were a lot of opportunities that have turned out to be great investments if you could acquire in that period. One of the striking things about people like yourself who've been through a few cycles is that there's always these events in this business, whether it be the savings and loan, the GFC, and now COVID, and recently the big run-up in inflation and interest rates that we've had the last few years. It's kind of like just part of this industry. There's going to be some sort of catastrophe, some sort of big sea change. And so what are you looking at now with, the company's been here 20 years, you've had a lot of wins. How do you see the market today, coming into, a time where there are a lot of multifamily developers who are struggling, rents have been flat for a few years. Where do you see the opportunities for yourself and your firm?
Well, we think opportunity time is coming. And it's been an agonizing 2 or 3 years where people have been basically just holding their breath, putting bridge on, and let alone the office situation, which is just really strange because of the delayed return to work.
Yep.
And also the change in work patterns. After the GFC, we got heavily into office, value-add office, and we had a programmatic partner out of Chicago called Walton Street Capital, and we did a lot of good with that business. But we bought vacancy, leased it, and sold it. And that came during a period of time when Phoenix had the worst office metrics in the country. We were 25% vacant. Nobody wanted to invest here, but we saw the opportunity in really a high growth rate in a more diverse set of industries in Phoenix that were backfilling space pretty rapidly. And so we stepped into that. And so we're buying office buildings for significantly below construction cost. And so we learned office, although I had done office at Pivotal Group previously. And so I think office is a significant opportunity today.
Yep.
And it's nuanced, and you have to pick your spots. And so we made our first offer on an office building just a few weeks ago, this cycle. So it's taken this long, right? And once again, I do think that part of the opportunity today is emerging capitulation. And so, and I think that does extend to multifamily, not single-family housing. I mean, I think that's been a pretty locked-up situation. But obviously, we're overbuilt across the Sun Belt. We have some time to absorb through this yet, although the absorption rate has been really robust. As you know, you own residential. I just think that whether it's new development or overbought, over-leveraged, vintage, syndicated stuff that's out there, people have been playing for more time with the bet being that rates will come in and that NOI will start to improve. And neither one has happened materially enough to save the day, so to speak.
What did you call it? Capitulation.
Right.
And do you want to kind of describe what you mean?
Yeah, so, I have a broker friend who described this phenomenon we're seeing in terms of putting bridge on and then bridge again as a hope certificate to death. And it's not, I do think that people have a really hard time, and rightfully so. Humans have a hard time quitting, hard time recognizing that the best decision financially is to walk away. And because there is this, and it's definitely wrapped up in ego, and I'm guilty of it myself, that where you're like, I can fix this because I fixed other stuff, right? And so I'm going to put bridge financing on, and we're going to get a year, or I'm going to buy a cap from my current debt fund lender, and we're going to be over leveraged, but I get another year, right? But you're investing capital to do that. And at the same time, rents are flat to down. And by the way, we're seeing a lot of gain to lease in the market right now. 5 to 15% gain to lease on the stuff that we're underwriting, yep. and a fair amount of delinquency out there and collection loss. And so clearly it's a struggle on the operating side. But even in new stuff where you have great income demographics, you have, concession that's, in the range of 15%,
yep.
That has to get burned off, and it's going to take time. I think that the lenders on the new construction stuff are fine. But I think that you have a whole generation of new projects where the developer's out of the promote. And that it just leads to a different set of realistic decision options. And so capitulation means where folks are just like, well, it doesn't make sense to continue. We've got to get out of this. And so let's let the market price it.
And that's the opportunity as the potential buyer to come in and buy that
right
at the today's market rate.
That's right.
Instead of whatever the cost that person has into it, which is what they're holding on to. That's what they own.
Yeah. Where you actually, it supports financing, with a tenure at plus or minus 4%, right? And that requires some real income.
And when folks do extend the bridge loan or do another rate cap, they have to your point, they have to put in more capital to do that. In many cases, they have to raise that capital from investors.
Yep.
So that conversation is they have to give some hope that money is money well spent, not good money after bad. And I think that's where it's a challenge right now for folks. If they're an LP and they're an investor and they have a capital call, should they put money in or not?
Mm-hmm.
Especially if they're not going to permanent financing, or if they're not, doing principal buy down. Sometimes those can make sense if they're going to actually do a principal reduction,
right? And
they're going to lock in some financing. But these bridge loans, what did your friend call it? It's a one bridge loan to the next.
Yeah,
as a bridge to
bridge, but a hope certificate to death is what it's called.
Right. And so to your point, you think some of those folks who are in those deals and some of the sponsors have to kind of look at it a little bit more clearly and say, hey, there's a time where I need to give up the ghost on this.
Yeah, most of this stuff was sold and capitalized as value add return profile. So high returns, relatively short duration investments. So 3, 4, 5 years. And a lot of that overbought, overleveraged stuff happened in 21 and 22.
Yeah.
And what happened is almost everything that was done then was debt fund floating rate financing that was marginally hedged, something like 2 years, maybe 3 years. And so those caps started burning off almost 2 years ago in some cases. And that has led to this, I think, pretty consistent pain, that you see people scrambling around to try to put bandages on, literally, and it will end. Inevitably, it will end. I mean, the market has to vote in terms of what those assets are worth.
I just have a couple other questions, but one of the key things with this business is raising capital from investors. You have debt capital, and then you have capital from equity capital. If you're giving advice to groups that are starting out, because you've worked with institutional capital, you've also worked with individual capital, what would you say about is the best way to think about raising capital? How should you do it? Is it with those different groups, given your experience?
Well, almost everybody starts with syndicated capital. So you have to, if you're giving advice to people about raising money among high net worths, it's really about conveying something that leads to trust, and then also having you have to care about that money as if it's your own, and you have to be able to communicate that. In my opinion, there's a lot going on in this crowdfunding driven or otherwise driven world where these are sort of layered syndications, where that's lost a little bit. And I do think that there's vulnerability in those kinds of structures, because LPs won't. And perhaps it's a strength too, because LPs won't feel like they have that personal relationship with the GP. And so, and I do think that, there are groups that evolve and decide to just be syndicators that get systematic about it and raise hundreds of millions and even billions of dollars over decades, that do extremely well because they build systems around it they're not just today companies, but, MG comes to mind, that have really been good at it. The Pillar folks out of Seattle, Jim Ullman for years, but he was a broker-dealer when he was a kid and learned how to dial the phone and tapped into wealthy individuals. It's not easy. I've known a lot of young people that have gotten into the business that haven't ever been able to really do it, and so they went back to work, for other folks. But then the next level, graduating to institutional, is hard for most. You have to think like they do, or learn to think like they do. You have to be willing to trade off control, discretion, lots of things. You're certainly going to trade off cost of capital. In exchange, you get the power of larger deals. But you have to build a team around it in the way of back office. You really need to learn. Accounting has to be absolutely locked down. Your investor reporting has to be really good, and your analysis and your look at the market needs to jive with how they think. It just means you have to raise the bar in order to get through those doors. And it's, for a lot of groups, even if they're successful syndicators, that's a hard graduation, not just because those doors are sometimes hard to push open, but because they're hesitant, to take on the costs associated with it.
Yeah, like anything, there's benefits to it, and that does seem like it's the natural progression of a fund. Is now you need to go raise more capital from institutional partners who can provide more and write bigger checks, but it's not always necessarily the right way for every group. In your case, that's where you gravitated toward, sounds like. But do you still work with individuals as well?
Well, we haven't raised money among individuals in a while. And I'll be really honest with you. So we have a debt platform at Everest, and we've had a couple of pref equity situations that have gone sideways for the same reasons I just mentioned, which is that things got overbought big time.
Yep.
We thought we were taking risk off by going pref, and so we put pref into new construction deals, which are fine. And really good sponsors. They're going to be fine. We're going to be fine. But we put pref into a couple of vintage deals with syndicators on a value add basis, and we have not done well with those. And just two. And as I said, I take it really personally. And I know my investors. I know all of them. And I'm hesitant to go back to that, just because of how hard it is for me personally.
Yep.
And the thing about having institutional partners is they are smart, really smart. They're well educated. They're well trained. There are systems in place where they are looked after. In other words, investment committee processes, and they are big boys in the industry, and working alongside of them is different than working side of investors that I feel personally responsible for, and where I feel the pain when we lose any money. It's really hard.
I think that's a really kind of profound thing to think about. It's not just about the business model and how to grow and how to be profitable, but at the end of the day, how do you want to deal with that question? Because there will be times where you're not able to get the return. There'll be times where, most likely, where you're not able to pay everyone all the way back.
Yeah.
And so I think that's really great insight. And I really appreciate you coming in, sharing some of these tidbits with us. This has been really insightful, and you're definitely someone who I want to give a call to every now and then when I have some questions, just given all the stuff that you have seen, especially in our market. So I appreciate you coming in again, and thanks for being here.
Thanks for having me. Stay in touch.